Hello, today on the Final Bar, we're going to talk about the market continuing to chip away higher, testing resistance levels, but it's led by the defense, utilities, real estate pushing their way higher with technology sort of in the middle of the road and financials and energy on the bottom. So we're continuing to see that leadership rotation. It certainly feels like we are. We're also going to answer a lot of your questions from the Final Bar Mailbag. We've had some fantastic questions about this market, particular tickers we're going to review, as well as some customization ideas. Ladies and gentlemen, this is the Final Bar. Hey everyone, welcome to the Final Bar. I'm your host, Dave Keller, here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close for this show. Help us make sense of these markets, reflect on what's happened from a technical perspective, behavioral perspective, connect the short term of today with the long-term trends over time. We're actually back in the studio today for one day only, preparing for our live market forecast panel coming up tomorrow. So doing a bunch of studio testing. Good to be back in the studio. Things a little bit rusty in here, but we're making it along pretty well. The S&P literally got to 3232 and change and turned right back down and went down to sell off in the last 10, 15 minutes of trading. So do you think people are watching that level or not? We've been looking at that for a while now, talking about the resistance from the beginning of June and whether we can eclipse that. Today, not able to do it, so that leaves the door open for next week to see if the momentum can continue upwards or not. Let's get to the schedule coming up on StockCharts TV and on this show. As I mentioned, this is Friday of a fantastic week we've had called Charting the Second Half. We've had so many great presentations. We had Mary Ellen McGonigal on the show yesterday. She gave her market outlook presentation earlier today. Chris Shavako was on, Ralph Acampora, Martin Pring, Linda Raschke. It was incredible, the group of people we were able to get together. Tomorrow we're going live with a market forecast panel. I'll be hosting, moderating a discussion with Julius DeKempener, Greg Schnell, Grayson Rose, John Kosar from Asbury Research. It's going to be a really fun conversation, and you'll have a chance to ask questions directly of the panelists as we go. Next week, we will continue the momentum with John Markman joining us for Behind the Charts. I sat down with John at a recent show and had a great discussion about how he thinks about charts related to all the other parts of his process. Then we have Andrew Thrasher joining us on this show on Tuesday, Gary Dean from sentimenttiming.com on Wednesday of next week. Let's get to our Wrap the Week segment. So on Fridays, what we love to do is Wrap the Week, which means spend a little bit of time just seeing how the week finished off, but then focus on Friday to Friday. What sort of changes have we had? How have the trends evolved over the last 5 trading sessions? What can we do related to last Friday to this Friday? I did want to start with a poll, though, because we've talked a lot about a weaker dollar environment and what that means. And so what we asked you was, what have you been doing in recent weeks related to non-U.S. stocks and funds? We gave you 4 choices: increasing your exposure outside the U.S., decreasing your exposure outside the U.S., keeping it about the same, or I never invest in non-U.S. stocks or funds. And here are the results. 32% of you said you were increasing your exposure. 34% of you said keeping it about the same, which means 66%, 2/3 of you are keeping it the same or increasing over the recent weeks. 6% of you decreasing your exposure to non-U.S. funds, 28% of you saying you never invest in non-U.S. stocks and funds. So my observations on this, I mean, overall, I think you can pick up on, if I was answering that question, I would certainly be leaning toward increasing my exposure only because it's all about the weaker dollar. And if you look at the chart of the dollar, you've seen this incremental weakness, sort of this pullback in the dollar after the volatility in February to March. You had the sort of sell-off May into June, and then this what you call a bear flag pattern resolved to the downside, and that usually happens about midway through a downturn. This isn't updated for today, but the dollar came off a little bit today as well if you look at the UUP. So overall, this weaker dollar environment in general will tend to favor stocks outside the U.S. versus U.S. stocks in general, right? I mean, there are many different moving parts to that relationship, but a weaker dollar certainly is a tailwind to outperformance of non-U.S. stocks. And if you look at the relative performance of the two, you can see that the U.S. has been underperforming non-U.S. stocks. So the reason when I bring this up, if you do buy into this weaker dollar thesis that we've talked about and that some of our guests have gone through, if you feel like that may continue, that would be the question I would be asking. What is my exposure to non-U.S. stocks, and how can I best express a weaker dollar environment in my positioning? Let's continue on, just sort of wrapping up today's session. We'll get to the longer term chart. So the S&P, as I mentioned, really I think the key story today hit 3232, right about there to the penny, came off a little bit. If you look at the daily chart of the S&P, you can see this level we've been talking about. This is the resistance level from the end of the first week in June. We retested that now twice in this week already, and then today, once again, we got right up to that level and closed below it. So until we can close above there, and I've sort of talked about 3250, just meaning we've at least gotten through the level and confirmed a close above that previous resistance. If we can do that, I think you can buy into the S&P returning to previous highs, S&P 3400 plus. I think you have to assume that that's a very real probability, but until we do that, we just haven't had the upside follow through. And what's interesting is, as this is happening on the S&P chart, we're getting the sector rotation that we've been talking about as well. So today, on a day when the S&P's up 0.28%, utilities up over 2%, real estate up 1.4%, then healthcare 1.4% as well, materials number 4. On the downside, energy, financial. So what do you not see at the top of the list? Technology, consumer discretionary, communication services. They're all sort of middle of the road right now. Tech outperformed by a little bit, but halfway down the list of sectors for the day. So overall, we've had this theme this week of a rotation, started Monday, rotation away from mega cap tech into other places. And what it's been flowing to are things like utilities, materials, healthcare, things like biotech, REITs all getting a bid today. Where it's not been going is technology, is energy, some of these things that you've seen rotated back onto the lower end, financials as well, as I mentioned, coming off a little bit. So mid caps up a little bit more than the S&P. Small caps flat for the day. So small caps actually were the worst of the three. Just very quickly wanted to point out bonds weaker today, gold stronger. So at a time when stocks finished higher, gold actually opened higher and continued to chip away, finished more toward the highs of the day, up almost just over 0.8% with the GLD going to 170. So overall, I think the base case of what we've talked about is, are we able to eclipse this resistance level? I'd like to see 3250 on the S&P, which for me would clear the way to go to the previous highs. Let's look at some of the longer term charts and see what conclusions we can draw on last week's Friday close to where we're at today. We're going to look at the Mindful Investor Live chart list and start with the long-term trend of the market. This is a market trend model I've been following for a number of years, and it essentially is built on exponential moving averages. It has 3 components: a long-term component using the 21 and 34-week moving averages. This turned positive in June and has remained positive through this week. The weekly PPO using the traditional settings, that turned positive in mid-May. And then the short term is looking at just a change in those moving averages. That turned positive about a month ago, 3 weeks ago, and has remained positive as well. So, according to this trend following model, again, I wouldn't automate anything based on just what I see here, but it gives me a bias with which to view the other charts, right? In general, when these are all positive, I have to be assuming that the weight of the evidence is more positive. In general, all else being equal, things are going to start drifting higher before they drift lower. When these things start to turn down, and it would start with the short-term indicator, which would be the spread of these 2 moving averages would narrow a little bit. That would be the very beginning of some sort of internal weakness, and you haven't really seen it yet. Overall, it's they've all been positive for for the last month now, and have remained so through today, closing higher than we were last week. The daily chart we've already gotten to, and I think going into next week, we did not get a breakout this week, breaking above resistance, which for me still means, again, the trend has been positive leading up till today, but we're up against major resistance, so it feels like the risk or reward is not super attractive on the upside, given the fact that we're unable to get above resistance. This next chart is looking at the cumulative advanced decline line, so it's a measure of breadth across cap tiers. So it's mega cap or large cap stocks the New York Stock Exchange broader universe, mid-cap index, small-cap index. I color-coded these last weekend as I was reviewing these charts. You can see I had them sort of like a stoplight. The large cap breadth breaking to new swing highs, the mid and New York Stock Exchange breadth sort of flat, and the small cap breadth breaking down. I have to put these other ones back in sort of the neutral category and would probably turn them positive if they break to new highs, if they break above the June highs like we saw from the S&P. So I think at this point, you'd say large cap remains positive, mid, small, and New York Stock Exchange broader universe all neutral. So not positive yet, and again, you still haven't had that follow through with mid and small caps that you might want to see right about now. What this leadership rotation has certainly caused the breadth on small caps and mid caps to turn higher, as they've done a lot better this week than we've seen in previous weeks. So that'll be certainly a theme to pay attention to going into next week. In terms of new highs and new lows, we've seen a consistent number of new highs over the last 2 or 3 weeks. And it's not been a ton of companies. It's been 20 to 30 stocks in the S&P every day that, on average, have made a new 52-week high. That's not a huge number, and it is not similar to what we've seen in previous bull cycles. Usually, coming out of a base, breaking out, you'd see a big increase in this number. The challenge is we're in this big February to March range, and most things remain in that range. So I don't see that really appreciating dramatically. But again, in terms of weight of the evidence, this number increasing would be one more way to validate a potential return to S&P 3400, because what that would tell you is that a lot of stocks are already testing their January, February highs and breaking to new highs, like some technology names obviously have already done. The more that number goes up, the more you're seeing other types of names, especially as tech has pulled back a little bit. For that line to go up, that would have to mean other groups and other sectors are starting to improve, and that would change the dynamic of what we've seen a great deal. This is a chart we've talked about and referred to a lot this week, and it's looking at the percent of stocks above their 200-day moving average, above their 50-day moving average. Not updated yet through today's close. This is through yesterday's close, through Thursday's close, but Wednesday, Thursday, that's finally got back above 50%. So 52% of the S&P as of Thursday's close above their 200-day moving average. This is one of the lines in the sand I'd been mentioning for quite a while. I would feel much more comfortable being bullish on the market if this line is above 50%, because if you look back over the last 10 years, cyclical bull markets tend to be met with this indicator being above 50% because most stocks are above their moving average in an uptrend. Cyclical bear markets are met with this line going below 50% because there's weakness and stocks are going below. We've now gone back above. The last time that happened, it whipsawed and came right back down. That was that early June high that we've talked about earlier in the show. If this remains above the 50% line, I think that should give you more confidence that the weight of the evidence, more positive potential for further upside. If for some reason this would rotate back lower, that takes that away as a positive catalyst and would make me be a little more skeptical. An interesting reading this week on the Bull and Bear Index. This is the AAII rating, so the survey of individual investors every week. It actually spread out a little bit, so the ratio is about the same. The difference between the two is about the same, 45% bearish, which is an increase from last week, 31% bullish, which is an increase from last week. So essentially what happened was people moved from neutral to bullish and bearish. Certainly could have been some, change around those votes, but basically you have more conviction, but it's on both sides of it. So more bulls, more bears. There's still, it's about a 3-to-2 ratio of bears to bulls. So still overwhelmingly negative relative to positive, but the numbers actually spreading out on both sides. It's actually kind of an unusual pattern there. The ratio of consumer discretionary to staples is the way I look at offense versus defense. I would just point out that over the last month, you've seen this reversion away from consumer discretionary into consumer staples. The cap-weighted ratio tells that story a little bit. The equal-weighted ratio really drives that story home because it takes the Amazon and Home Depot overweights out of consumer discretionary, and it's a better read on sort of the average stock in each universe. You can see that it's been favoring consumer staples for the last month now. It ticked up a little bit this week, and interesting is it actually ticked down as Amazon sold off along with the rest of the FANG trade. So overall, it's an interesting ratio to watch. Consumer discretionary is starting to outperform technology over the last week and a half, but overall, it's still relatively muted over the longer term. The long-term trend has seriously been, or has consistently been favoring technology. Semiconductors on a relative basis pulled back a little bit, overall still in a primary uptrend, and this group is important because when these stocks are doing well, the overall market tends to be doing well because they're such an integral part of how we operate and how businesses operate. So overall trend remains positive, certainly pulled back this week after a spike higher, but overall primary trend remaining to the upside. This is a really interesting chart, the way that this has evolved. This is the relative performance of small caps, the Russell 2000 versus large caps, the S&P 500. You can see the downturn in this ratio going into the March lows. It actually came up, and for the 2 or 3 months after the March low, it's been actually in a nice uptrend, showing overall an outperformance of small caps versus large caps. That all changed, and last week when we had this discussion, we talked about this reversal back to the downside. And all of a sudden, this looks like a bit of an upturn before the next leg down. This actually turned around and rallied back up a little bit. So this ratio of small cap to large is in limbo of sorts. Overall, though, I'm seeing lower highs and lower lows, and until we break above the most recent swing low, it's suggesting overall that that remains relatively weak in favoring large caps over small. That's our review of the Mindful Investor Live chart list. Again, we have this stored right on my homepage, The Mindful Investor. Go to that blog and you have a link to go to this chart list, save it, do whatever you want with those charts. But that is our take on the long-term picture and how it's evolved over the last 5 trading days. We're going to take a quick commercial break, back answering your questions from the Final Bar Mailbag. We'll see you in a minute. Hello, welcome back to the Final Bar. I'm Dave Keller here at StockCharts.com. Thanks for joining us for the show every weekday after the close. As a reminder, we love to hear from you. Send us your questions via email, thefinalbar@StockCharts.com, or just tag us in a comment on Twitter @FinalBarSCTV. We get a lot of fantastic questions about the markets, about market structure, dynamics, decision-making, behavior, biases, charts, indicators. Nothing is out of bounds. Let us know what your questions are, and we'll get to them in a future mailbag segment. Let's open the Final Bar Mailbag right now. These are all questions we've received from you in the last day or two. We've received so many, so I've tried to get to as many as we can. Question number 1, looking to start a position in this blue chip name. You're talking about Biogen, which I'm showing you on the screen. Here are my reasons from a technical perspective. The IBB breaking out. Biogen's one of the top 10 holdings. It appears to be holding support at nearing the last gap, which I think you're talking about, this gap from last October. Multi-year multi-year relative trend low relative to the IBB, and the longer-term uptrend, the 200-day is sloping higher. So I agree with everything you just said. Let me just talk a little bit about this. My guest yesterday, Mary Ellen McGonigal, did such a great job talking about the cyclical nature of biotechs and how they've done very well around this time in the period. If you look back to 08, 09, 2010, she drew a really interesting parallel that made me think a great deal. So if you missed that, go back to her interview yesterday. I know she'll touch on it, or she touched on it on her special event today, her second half of the year outlook. But we talked about biotechs in particular. Biogen has actually been an outlier, right? So while biotechs overall as a group has done well, IBB, the ETF, has held up very, very well. Biogen's kind of been the ugly member of that group. It's actually been underperforming. While most stocks are actually rallying, this broke below its 200-day, broke to a new swing low here. So right about here in June, I would have questioned this idea of looking at biotech, or looking at Biogen. A couple things have changed, though, and you asked this question about a week ago, and you sent it to me again. Thanks so much for that. I think the fact that we broke below support and then reverted higher is very compelling. The fact that we were oversold and rallied from those levels is really good. So I think you have a clearly defined support right at 260. We've now established a higher swing low, and I love how that lines up so well with some of the lows we had at the end of last year. So, when support becomes resistance or the opposite, can be very compelling. So that breakout was really good. All of a sudden, you have a bit of an island reversal of sorts. I don't know if it's the ideal version, but, gap down going into the pattern, a gap up coming out of it. We're now testing the upper end of that gap and holding. So you have a clearly defined support level there as well. And now we're in an uptrend. So, an aggressive take would be to get in on a name like this here, which I think makes sense. The more conservative version, or maybe the way to validate that, would be breaking above some of these swings. So breaking above the 200-day would make me feel a little better. Breaking above this trend line using the April and May highs might be an interesting thing to look at as well. So really, in terms of what you do with this, it depends on how aggressive you want to be, for sure. I would tell you that from a risk-reward perspective, it sets up pretty well in a group that's been doing well. It's been lagging behind some of those names, but starting to turn up, and has a clearly defined support levels and potential for upside going back to those April highs, which I think is pretty decent. Great question. Again, Mary Ellen did a great job talking about some of the fundamental questions you answered as well. Question number 2 is on BABA, ticker BABA. This is Alibaba. And just an overall take on the chart. So, overall, this is the charts that look like this would make me feel pretty good. We've talked on this show at times. I can't remember all the things we've talked about. So much great content we've been able to go through on the show, which I've enjoyed. But one of the things that I talk about are the different time frames of technical analysis: short-term, medium-term, and long-term. And all else being equal, you're better off as a long-term investor buying stocks that have had a strong 1 year, 6 to 12 month period, especially on a relative basis, and have pulled back recently, right? The whole idea of buying on the dips, buying a stock that's in an uptrend, but it's pulled back a little bit. And if I think of more of maybe an idealized version of that thesis, Alibaba is not a bad example of that right now. You've had a base. It hit a peak in January. A lot of stocks peaked out in February, as the market did. But Baba actually hit a peak just above 230 back here in January, came off. This wasn't as much of a V bottom, but more of a rounded bottom. If you look at it, again, it depends on your scaling for sure. But, then retested that previous high around 230, pulled back a little bit. So it looks like that cup and handle type of pattern. Now breaking to new highs, pulling back a little bit. And so overall, you have this stock that's in a decent uptrend, pulling back. And overall, if I, continued to buy names, charts that looked like that overall, I'd probably feel pretty good about my overall approach there. So I think it's setting up very, very well. The key with anything like this is identifying support. And so resistance was at 230. As long as we remain above there, that primary trend remains positive. And stocks above 2 upward sloping moving averages in general, pretty good. So a good chart, and thanks for that question. Third question, enjoy your show and watch it every day. Thank you for that. Should we be concerned with the lower highs in some of the gold stocks like Newmont Mining and RGLD, Royal Gold? Really, really good question. Here's Newmont Mining we'll look at as an example of that. And I think what you're referring to is the lower highs here, right? So you have the peak in May and the peak in July. So what you notice here, right, a lot of stocks like BABA that we talked about, most stocks peaked in January or February, pulled back into the March lows, and now are in some range down here, whether, trying to figure out if they can beat those February highs. You can see why Newmont Mining was one of the, was the top ranked scooter stock we had in our rankings for a while, and was in the top 10 for months because of this trend. Look at this relative performance, February, March, April, while most stocks were just struggling, it was continuing to make new highs. Things have changed a little bit, and I think what you're getting to is an interesting point, which is the lower peak. The first thing I'll tell you is what concerned me here in May was the higher highs in price, the lower peaks in RSI, the bearish divergence, which ended up playing out pretty well because we made a new swing low. We've now rallied back up and have now made a lower high, and on the weekly chart, that's what your eyes are going to be drawn to. What I'm looking at, though, is on the tactical trend, which is more of the short-term trend, looking at the last couple weeks, we're making a short-term pattern of higher highs and higher lows. So I think based on this short-term read, as long as we remain above this last swing low, which is around 59, the chart overall is in a constructive position. I think a break above 64, which would put us on a closing basis above those highs from July, I think that would clear the way to go and retest those previous highs, if not further. And if you dial in the Newmont or RGLD or any of those mining stocks to the overall gold thesis, which I still think is one of the better long-term charts that we've talked about from a broader asset allocation perspective, could be setting up very well. So on a chart like this, you have to realize we've now had higher lows, lower highs. We're sort of consolidating. You wait to see really which way this breaks, and I'd have no problem, leaning more onto the long side as long as you have a clearly defined support level, defining your risk, defining your downside. Next question, use relative strength as a staple indicator. I would totally agree. When it comes to relative strength between two assets like growth versus value, large cap versus small cap or something like that, when the ratio changes, what do you use as your guide to make the change from one asset class to another? I notice you also have the 50 and 200-day moving averages on the ratio charts. Does a crossover have meaning? It's a really good question. So I have this chart list, one of these here, this one called ratios, which just a place where I store a lot of these different ratio charts. And yeah, my standard look at a ratio, if I'm looking at the relative performance of semiconductors, if I'm looking at financial versus tech, I tend to have the ratio, and the main thing I'm looking at is how the ratio is changing and what is the trend in the ratio. And if it's making lower highs and lower lows like financials versus tech, over the long term, there's no great reason to want to get into it. This is why in early June you heard me talking about, is this a rotation away from tech into financials? It didn't end up being. That ended up reverting back lower and making new lows. But once again, all of a sudden you see tech starting to underperform. So, for me, when the ratio turns against that longer term trend, that's what I'm looking for. Do we see enough of a pivot? The moving averages, I don't use them as a system necessarily. So crossovers, crossing up, crossing down, I don't know if that's the main way I would think about it. But certainly a visual guide to help me make sense of it. Maybe one of the examples that could tell us a good way to use it would be stocks versus bonds, which is somewhere around on page 2. Sorry, here we go. When I'm thinking of stocks versus bond, this ratio is how I've a lot of times thought about it. And what's happened is you have a clear downtrend, you have a clear uptrend, and now you have this sideways trend. And the way I just described it is the way I tend to use ratio charts. For actual signals, for actual triggers, I would look at a chart of the S&P 500 and use levels like the resistance 3230, 3250, whatever it is, on the bonds, on the TLT, it's key resistance and support levels and what the trends are telling me there. The ratio tells me which charts I want to dig into a little further and identify where to lean on one side or the other. So I would say no clear signals for me. I think for me it's a great way of understanding the relationship between all those individual charts. And the reason why I started looking at ratios was if you just look at a series of individual charts, you can get the blinders on and just focus too much on those signals and not think about the forest for the trees and how they relate to one another. And that's why ratios are a really important part of my process. Those questions were fantastic. Thank you all so much. And I abbreviated them, but they're really thoughtful, and thank you for that. I look forward to answering more next week. We need to wrap the show. The 3 and 3, 3 charts in 3 minutes. Here we go. Chart number 1 is the AAII Bull Bear Survey with the spread. This is, we talked about this earlier when we were going through the Mindful Investor Live chart list. It's an interesting read to see an increase in bulls and an increase in bears. So what this tells me is there was no strong conviction, no real change with people pivoting bullish to bearish or the opposite. For me, overall, I think it continues to represent that indecision, right? The rate of change, the change in these opinions is what I've often found pretty interesting. The most interesting signals are when we get to extremes, and if this bearish reading continues lower, we get below 50% of the respondents being bearish. That's when I start to make historical comparisons to previous market phases. Chart number 2 is the chart of the materials sector. We didn't talk a lot about sectors. We're going to dig more into them on Monday's show, but I did want to point out materials just made a new six-month relative high to the S&P 500. That's the panel at the very bottom. You can see it's also rotated above trendline resistance using the January and February highs. It's broken above the previous swing high around 60, which means the XLB now testing all-time highs here for the last year, and it made a new closing high with today's rally. So overall materials now making a new 52-week high, making a new relative high. And if you've not been looking at materials, not just gold stocks, but the other parts of it, this more than anything else should, I hope, compel you to consider that a little more than you may have. Finally, the last chart is the chart of utilities, the XLU. This is an interesting sector because it's been on the top, of the pile of sectors the last couple days. Really moved up significantly today, and on a relative basis has still been underperforming, but just upticking a little bit. So it's a little earlier on, and I would love to see if the sector is able to make new relative highs, continue to appreciate on a relative basis, if it's able to reclaim its 200-day moving average, and most importantly, get above that key resistance around 62. If you get that completion of that rotation, that's a sector I would certainly be looking at, especially with the dividend component. And that income side of it, with so many companies cutting dividends, could be a compelling income play around here as well. Folks, that is our show. Thank you so much for joining us today on the Final Bar and all week. We're super excited for our panel tomorrow. Reminder to join us Saturday, noon Eastern, 9 a.m. Pacific, as I pick the brains of some of our StockCharts contributors and get some of their best ideas for the second half of the year. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great weekend. We'll see you next week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.